Let's bring in Kathryn Rooney Vera, Chief Market Strategist at StoneX. She joins us now live. Kathryn, good to see you again, and welcome back to the show. You say stay long equities, but skew towards lower risk options. Explain.
Well, sure, and actually the call was to play the laggards, so industrials, materials, financials, those cyclical sectors that have yet to play catch up with the all-star sector, which is tech, driven specifically by AI. So the idea is to stay long equities because likely inflation numbers are going to come in pretty benign from now through year end. The Fed likely stays on hold, maybe hikes once. That's not going to cause a big correction in the markets. So the view here is that this multiples expansion-driven market rally that we've seen has some legs. So we're not saying exit equities completely. What you want to do is look for value in cyclicals that have not performed well year to date. Now, going into 2024 and for a longer term perspective than 3 months or 6 months, Martin, what I'm telling clients is protect those long positions. And there's a myriad of ways to go about protecting portfolios.
So I need to ask you this about tech, and we've been talking on and on about for at least a couple of weeks now about how the tip of the spear of leadership is broadening, and that's I guess a good thing,
yes.
Right? Otherwise it starts to look a little fragile, especially at those valuations, right? But geopolitically, we are expecting the president to sign an executive order to limit critical U.S. tech investments in China by the middle of this new month, which we just started, which is the middle of August, right? Has that been priced into tech, and is that something that could take at least some of these names down, do you think?
Well, geopolitical risks are always something that could take leaders down. I do think a lot is already priced in. This is the best case scenario that's priced in. So any shot to the bow of the main driver of this market rally, which is 7 stocks, would be net negative for the equity markets, whether it be some conflagration with regard to trade policy with China or something out of Ukraine or any geopolitical risk, I think could hit risk sentiment. And risk sentiment is very, very positive right now. And that's favorable to the high flyers, to the names and the sectors that are ultimately cyclical in nature and ultimately benign in a low interest rate environment, and that's tech. So that's why I'm saying, if we're going to continue with this momentum-driven rally, which it seems like we will for the next couple months, notwithstanding, Martin, of course, any geopolitical tensions that erupt, then look for value in those underserved sectors or laggard sectors, while at the same time protecting yourselves with attractively priced put spread options and other alternatives within the broad asset class spectrum.
Kathryn, talk to us a little bit more about where the U.S. consumer is at right now. And actually, before you do that, we talked to an earlier guest about exactly that theme. I want to play you a soundbite, and take a listen to this, and then we'll continue talking after. Okay, well, we don't have that. In any case, you're saying the consumption right now is driven by improved purchasing power. Where's this extra money coming from?
Well, inflation is dropping. So liquidity is actually, it's still in the system, but it's starting to evaporate. That's a net negative over the course of the next 6 to 12 months. But as of now, inflation's deceleration makes real incomes positive for the first time. And that's a huge boon for the U.S. consumer. So my view, Martin, is that the Fed is likely going to have to either choose between two things. One, inflation not getting to the 2% target, perhaps accepting a higher inflation target or changing the target altogether. Or two, bringing the U.S. consumer to his heels and breaking the back of the service sector inflation, which in my view is very, very difficult to do when you have a robust consumer confidence skyrocketing, real wages positive, 401ks enormously in the green, and economic activity being robust with leading indicators or rather financial conditions being positive. So that combination doesn't tell me that the main driver, the whopping majority of core PCE, is service sector inflation. That combination does not tell me that we're going to easily get from 4.2% for PCE or 4.1 that it came out down to the 2% target in this soft landing approach, unless the Fed changes its target or acquiesces to a higher target.
Kathryn, at a sector level, Amazon and Apple this week, are they going to make or break this momentum trade? And we really can't be monolithic about tech, can we? What should we own with regard to subsectors? Is it the picks and shovels companies that are really building out this AI transition, cybersecurity, etc.? Is that where you want to be?
Great question. And there are subsectors of tech that that you can even find financial services or insurance companies that are tech-like in nature. So these are names, these are subsectors that have yet to play catch up with the technology-driven trade, with everybody looking at the major heavyweights in the ETF baskets. And we have the Magnificent Seven and Microsoft and Meta and Facebook comprising a huge percentage, maybe 20% in some cases, of the respective tech ETFs. So what I would say is do the homework and look beyond the AI-driven tech names, which have extended themselves in terms of multiples. I do think that earnings have to play catch up. There are more attractive subcomponents. As I mentioned, there are technologically advanced financial services firms, or there's many different areas that you can go within banks or within industrials or materials to add to your portfolio in the equity space without having to be long AI and tech at these extended multiples.
Kathryn, talk to us a little bit more about earnings, because, I mean, so far, we're about halfway through. In total, they've been better than expected, right? Coming into the earnings season, we've been looking for probably minus almost 6% earnings growth. We're at +3 right now. You talked about earnings having to improve. I did a little bit of math. In order for the SPX to be worth that 20x forward valuation, you've got to get earnings growth up to +6%. Are you confident that it'll be able to do that kind of catch up?
Yeah, that's right, Martin, and I appreciate that analysis. That's the truth. The truth is that especially if you look at, if you delve even further into the tech space, the earnings growth, I believe, has to be a bit more than that as well. So yeah, I do think it's going to be a tough run for earnings going into next year, especially in this long and variable lagged impact of high interest rates on consumer demand, on delinquencies, on defaults, from consumer loans to auto loans to bank loans. Bank lending tightening, bank lending standards are tightening. We're going into a more difficult macroeconomic environment going into 2024. So I think that it's going to be tough for earnings to match, the expectations that multiples are indicating is really price sensitive and price driven.
If we could turn to, Kathryn, the lagged variable impact of tighter policy, have we seen the worst in the financials and the regional financials in terms of the stress, or are there more failures potentially to come?
Well, part of any credit cycle, and we are in an economic cycle and always are at some point of the economic cycle, is some defaults and difficulties for corporations, high yield or junk bond status or emerging markets, leverage loans to really repay their obligations. In this case, it's a little bit different because the corporations, in many corporations, were able to refinance at lower rates. So they're able to postpone the payments and have a more favorable maturity wall. So I think that's part of the reason why we have not seen this credit cycle come to fruition as one would have expected. So I do think that this is less structural in nature and more delayed, let's call it. So the impact of the long and variable lags have not yet been felt because we do not have recession, because we do not have delinquencies or defaults. I mean, when you look at consumer lending, it's still growing. Consumer confidence is still growing. People are still spending, even though getting a consumer loan or getting a 30-year fixed rate on mortgages is now 7.2%. People are still doing it. So I think that this is just a delayed effect and not a permanent structural change. And the reason that we have this delay is because of this enormous injection of liquidity, which went long in the tooth in terms of its longevity. And I think that's why a lot of we analysts and economists got the call wrong going into 2023. We did not expect the duration of this liquidity to be as long as it turned out to be.
Kate, you know, when I take a look at things in totality, it just seems too Goldilocks to me, you know?
Yes.
It just seems too good. Inflation is easing back, that's good. Growth looks still resilient. Consumer still looks pretty strong as well. Market's up at 52-week highs, and the Fed is probably done. And the next move after a pause of who knows how long is going to be a first cycle of cuts. Yet when you take a look at, and the VIX, last I checked, is
the VIX
is almost dead, right? It's like below 12.
Right.
But we just started August, and August and September, as you well know, are months when volatility tends to pop, if not spike. Is that something you're expecting this year, and what could cause that spike? And I'm trying to get to the unwinding potentially of the dollar-yen or yen-dollar carry trade.
Yeah, what you're talking about probably has a lot of seasonal effects that come into play with lower volumes in the August months. But I do think that low volatility at this point gives us opportunities to protect our portfolios. You can get very attractive put options cheaply at this level, and I recommend those for portfolios that want to remain long tech, long S&P 500, but specifically long tech. You can cover that position and protect that position for an inexpensive amount. And why is that, Martin? That's because the VIX is very low. So the market is currently, the equity market specifically, has discounted in their current pricing the best case scenario, the absolute best case scenario. So we can ride this a little bit longer for sure. But I do think the next stage of the cycle is a downshift. So we want to be prepared with that. We want to be buying sectors and asset classes that do well in the next phase of the economic cycle. Because in my view, Martin, it doesn't mean that because things are going so well as they are year to date that we've avoided recession completely. This is an economic cycle. Recession is inevitable. So we need to be also accumulating positions in sectors that outperform in down cycles: staples, utility, healthcare, and energy. We also have to have gold positions, high cash amounts, and protect with those options that I previously mentioned.
Sounds wise to me. Yeah.
Kathryn, we'll wrap it up there. Thank you so much indeed for joining us with those insights. Great to see you. Kathryn Rooney
My pleasure.
Vera,
Thank you.
From StoneX. Thank you.